Hey, Devina's here.
Yeah, hi Rahul.
Hi, Devina. Hi. Wonderful. Thanks to have you for these spaces. I started a couple of minutes early to do the setup, and
Yeah,
meanwhile, we are already past it.
right. I
Yeah,
just realized I needed to give some permissions to the app, it took me a minute.
yeah, yeah. It takes quite a bit to set up. You'd asked me to add two of your colleagues. I'm trying to find them so I can add them as
Yeah, I
speakers.
can see Alok Kumar. That, that
Okay, I'll add Alok. That'll be easy if he's already there.
yeah, I'll just
Alok 04 something.
I just thought in case somebody wants some specific data, I might need them.
Yeah.
So we made wait another minute or so to start.
No, we start on time. Thumb rule of
Okay,
life. Always start
sure.
on zero audience. Also, we start on time.
Okay.
Okay,
So,
so
so then let's start.
I'm going. Yeah. Very quick introductions. So, Devina is co-founder of First Global. If I'm not mistaken, First Global is 30 years, right, Devina? Now, about 30 years.
Yes, 30 years.
Okay, 30 years. So a massive track record, huge success, and a voice of reason and sanity in especially times like these. So I've done a investor hour with Devina earlier, and I've been in touch with her. And when all these things were happening about small cap, mid cap, large cap, and also the whole LRS thing about investing internationally, which is now going into effect on 1st of October with a higher TDS rate, I just thought we should get her in and talk this stuff. Uh, Hopefully, there'll be enough in there to help all the attendees take more meaningful investment decisions. Of course, there's no advice being given. It's just information and input and opinion, and you can, make the most of it. Uh, so that's one. Second, I'm co-hosting this with Prince. Prince has this amazing community on X, and where he hosts spaces almost every day, if I'm not mistaken. And he's got a very loyal following. So we do this. We always have him over so he can back me up in case I fumble with the technology. And even as we speak, I think I just saw Safir over here. So that's wonderful. Safir, welcome to the spaces. You're the surprise guest for today, I believe. Uh,
Thank you and good evening to
and
everybody.
good evening. And Safir, on behalf of everyone, many congrats. I did see a post from you saying you guys were ranked amongst the top law firms in India recently. So many congrats on that.
Thank you so much.
Yeah, and if I may just add that it makes perfect sense for a top-notch lawyer to be on a podcast discussing stocks. It's so logical. But your discussions on stocks, of course, have enticed people to that. So we'll see how that goes today. Chalo, wonderful. I'm going to kick it off with Devina, of course. Devina, a broad question for you. Lay the ground for us in terms of what's happening in the economy and stock markets. Just give us the lay of the land first to begin with.
Uh, Hi, Rahul. Good evening to all the listeners also. Thanks for taking the time on a Friday evening on a long weekend to do this. In terms of let me first start with the market, Rahul, because the economy is a whole different game altogether. So, in terms of the market, I don't know whether you had seen that, but end of March, I had tweeted that this is the time to be in the markets, and all of us understand the risk of not risk of being invested in the market, that the markets might go down, but there is also a risk to not being in the market, because if you're not invested and the market goes up, then you have lost out on the up move, which you can never make up when the move is fast. So we had done this exercise last year, and the numbers have changed a bit, but the percentages have not. So if you had invested in 1980 100 rupees, so that would have become last year 44,000, this year 56,000, something like that. But the trick is this, that in this 40 odd years, if you had missed out just the 10 best days, you would think 40 years mein 10 days is nothing. you would have lost out on two-thirds of the return. So that 44,000 goes down to 15,000. If you miss out on the 30 best days, which is just about one day, less than one day a year, I mean, 30 days in 40 years, you lose out on 90% of the returns. So as I had said in March, this is I think March 28th or something, my tweet is there, that this is one of those times where if you are not invested, you will regret it. And with no ifs and buts, I had said, if you ask me today, is the market at its bottom? I don't know, but it is somewhere in the range. And definitely the probability of it going up is higher. So since then, if you see, the Nifty at that time was less than 17,000. I think it was 16,900 something. So it's obviously gone up 17, 18% since then. But even now, my view is that we are closer to the beginning of the move than the end of the move, as far as the Nifty or Sensex or the large caps are concerned. And again, you step back, all of us have this figure in mind that if you invest in the Indian equity markets, you will get a return of 15-16% compounded, because that's been the return since at least the indices have been around. But the variation is very high, and the variation, people think, okay, 1 year you will make high return, next year you will make low return, but it is not even on that basis. Even if you look at it in a whole decade basis, so let's say you invested in 1980. In the next 10 years, your 100 rupees would have become 700 rupees. But if you invested in 2010, your 100 rupees after 10 years would have become only 230 rupees. And, that's only a compounding of 8.8%, I think, in a decade when fixed deposits used to give you 7.5 or thereabouts. So, there can be a whole decade when you really don't get compensated. But the point is this, that once you have a decade like that, and then you start to come out of it, you start to outperform again, then that run is likely to be longer. So even if you look at this decade, from the beginning, because of a lot of global factors and the pandemic and the war and this and that, we've still not compounded at any great number. We are still around 12.5% compounding. So point is that we are still very much below the trend line. So the risk of a crash comes when you are above the trend line. If you're this much below the trend line, there is, typically no risk of a huge crash. So even now, as I said, for the large caps, my view would be that you should be invested to whatever extent you want to be invested in equities. I never say, even for young people, that put 100% of your money in equities. I mean, like yesterday, my nephew and niece were asking me, I said, you might want to buy a house sometime later. So, I would not say that put everything in equities, always have a balance. So this is as far as the large caps are concerned. But there's a somewhat of a different story on the small cap, mid cap side. There has been a lot of, frenzy around it. Even if you look at mutual fund flows, there has actually been, I think, a net outflow from large cap mutual funds and a huge inflow into small cap funds. Now, the thing in small caps, again, you step back, look at the data, and you see that there have been huge crashes which people forget about. It is a risky end of the market. Never forget that. So in 2008, from that peak, the small cap index had fallen almost 80%, 78% to be exact, over just about 14, 15 months. And then it took another 6+ years to come back to that 2008 peak. So, I mean, I see all this picking and choosing of data, people saying that small cap index can go up 5 times. Look at this period. I mean, what people don't realize is that percentages are not symmetrical. If something falls 80%, if it goes from 100 to 20, even if it goes up 5-fold, you're only back to base zero. This is a very basic thing, but I see the so-called influencers and other people giving these kind of data points. That this is what you can expect in small caps. 6 साल में 5 times हो गया. without giving the picture that it had fallen 80% just before that. And that was not the only time. Again, you had this frenzied bull market in small caps in 2017, and 2018 onwards, again, in about less than a year and a half, the index fell 65% from the top. So again, almost a two-third fall. So again, it has to triple to come back to that number. This is what people don't realize, that when something falls two-thirds, it has to triple to come back to that number. So, but really the thing with small caps also is this, that when I say that the index came back to that level in 7 years, actually the small cap index churns 18-20% every year. So in 5 years' time or 6 years' time, it almost nothing of the original index is left. So the stocks that made that high again in 2016 were not the stocks that crashed in 2008. 2008 wale stocks, they went out, they became penny stocks, they went to zero and so on. So that's the part people forget. So it's a risky end of the market. So you have to play it very carefully. Another argument I hear often is ki, index ka jo bhi hota hai, I am picking my stocks very carefully and I'll do well. So how likely is that? So in that 2008-9 crash, I was looking at how many small cap stocks went up. It was a grand total of 1%. In the 2018 to 20 crash, it was 8%. So it is foolish to say the least that you are this great genius who will have investments only in these stocks. One other thing, price is one thing. With small caps, what often happens is that on the way up, there is liquidity. When they start to crash, there is no liquidity. So you can't even exit. The price also becomes theoretical. So, I'm not saying never invest in small caps, but limit your exposure. So both in our PMS and our small case, for example, we rarely, if ever, go about 20% exposure in small caps. So, as I have said very often and on many platforms, that investing is a loser's game. You win only if you don't lose. So your first and most important part of your investment or portfolio management is to make sure that you don't have a big loss on your capital, you don't have a big drawdown on your capital. So this would be my sort of base for the markets, at least, Rahul.
Yeah. So let's hold that thought on the economy. We'll stick to the market for now. We'll come back to the economy. So, you made so many interesting points, so many thought-provoking points. Just for the listeners, Devina recently wrote a piece for Money Control where a lot of this data has been shared. I'll try and put up that note on my. I'll make a post on Twitter or X after this, and you can, get that those data points. So I think what Devina you're really saying is that so other than the points of you want to avoid losses, you want to remain invested for long periods of time. Timing is very difficult. Don't data pick. You're basically saying at this point in time, it's a story of two markets. There is a larger cap market, let's say a higher quality market, where you're saying you're closer to the beginning than to the end in terms of the opportunity. And then you're saying that there is a smaller cap, mid cap market where it's largely lower quality. There are good quality, but largely lower quality. And that's where the excitement may have gone a little bit overboard. And how people read these two will really, how they read and how they decide to act on it will, probably decide how their portfolios do going forward. Uh, Safir, you're a very, active investor, not in terms of a trader, but active in the sense you're tracking all this, you're reading all reports in between your legal briefs and all that. What's your understanding? Give us your opening comments on this large cap versus small cap and your lay of the land for the stock markets.
Yeah, so when it comes to investing, I, have completely tried my level best in the last several years of my investing career to remove the bias when it comes to large cap, mid cap, and small cap. For example, it does not matter to me if I'm buying a large cap vis-a-vis a small cap. I have to look for an opportunity in the market, and my ability is to try and understand if there is an opportunity in the market if that opportunity is understood by me, both first as a company, then as a promoter, then in terms of the magnitude of what that particular sector can lead to, then I go on the assumption that if a company is to lead in a sector, maybe it will do better relative to the sector. And if it doesn't, usually I will not have a single participation in the sector, at least pick two companies. So the point is that I don't have this sort of bias when it comes to large cap versus small caps. Even in this market, I do predominantly agree with the view that there is a euphoria in the small caps because companies that are not being understood and are very difficult to understand. You cannot take a company and say I'm going to multiply it by 100 times, 200 times, 300 times without even a proven track record. In terms of even some of the IPOs, certain companies have records of performance only in the last 1 or 2 years, which could be attributed to many reasons, including accounting, restructuring of accounting and things of that sort, related party transactions, and many other things. It is not, you cannot be gung ho essentially in terms of what you don't understand. I mean, it's sometimes the stability, and what Devina is saying in terms of liquidity is absolutely right. Because if the market goes through a shakeout and you do not understand the company, then you would have, by the time you decide to react, the stocks would have retracted a lot. But on the other hand, if you understand the company and usually you are accustomed to market compounding at 13-14% per annum, you will have the ability to withhold those particular stocks and maybe even average, and if you have disposable money, etc. And therefore, you will be back on track even if you are derailed. Having said that, like on any day, like I'll give an example of today, and I'm not going to talk about a trade, but as an example, my job is to find where I can deploy my money to the best optimal returns. As long as I can beat fixed deposit adjusted for risk, I'm fine. And if I find the opportunity in a large cap, it will be a large cap. And if it's in a small cap, it will be in a small cap. So I buy both, but I will never overdo anything. I will never overdo a sector. I will never overdo a market cap, and I'll never overdo sort of buying four players in a sector just because the sector is booming.
Yeah, yeah. And I think that's a wonderful point you make. And I just want to add to what both Devina and Safir are saying effectively is that uh, if you are discretionary in your investments, uh, you have the choice of whether to invest in a small cap or not. And you have to be careful. You have to follow the process and buy the right small cap. You don't get it, you don't get it. Your money will end up in a large cap. The other day, I went through a presentation by a very successful mutual fund in India, which does not have a small cap fund. And they were showing data on what's happening in the small cap space. And they showed, of course, the point even Devina mentioned that large cap funds are actually losing money, and there's money rushing into small cap funds. Now, notice one thing: the small cap fund has no choice but to buy small cap stocks. Exactly the opposite of what Safir is saying about Devina is implying. So they have to keep buying stock. Now, if tens of thousands of crores are going into small caps, and small caps have only limited amount of liquidity available, what do you think is going to happen? Now, here's a very interesting data point they shared, Devina and Safir. They showed that the average number of stocks held by a small cap mutual fund has actually increased quite dramatically in the last 1 year. So, to deploy the money they were getting in, they're buying more and more stocks, which means moving further and further away from pristine quality to get those stocks. And then, if something goes wrong and they have to liquidate, and you can imagine what's going to happen. They're stuck with poor quality stocks and poor liquidity, and they're going to get, they could be in water, hot water. So, yeah, so the situation is what it is. Devina, coming back to you on this small cap, large cap, uh, how does the economy feed into this right now? Uh, Talk to us a little bit about that. And then, if you could spend a little more time, I don't know whether you want to talk sector or not. I would love it if you can talk a little bit about your approach, which sort of tries to limit all these biases, etc., and the way you guys look at data, so that maybe that will be helpful for the listeners, as they decide what to do with their money.
Yeah, Rahul, you woven in quite a few questions in one, I must say. And you know what Safir was saying was exactly right, that you must diversify your bets. I mean, essentially, what he was saying was that don't skew towards only one sector or only one type of stocks or so on. So that's very important to diversify your bets. And the data point you shared, Rahul, was also very interesting. That means essentially that to deploy the money, the small cap mutual funds are in all probability lowering the quality or whatever their criteria initially was. So which means that if I mean right now our systems are not showing that small caps are going to crash tomorrow or anything like that. But I'm saying this means that if at all at any point that there is a slide, it will tend to accelerate because all these people will be holding stocks that may not be liquid anymore. As far as the economy is concerned, still some concerns areas, Rahul. One thing, of course, which has been around for some time, which we all know about, which I've spoken about earlier also, that the recovery was more a K-shaped recovery. So it was like if you look at luxury cars selling very well, luxury homes selling very well, and a whole different picture emerges when you look at two-wheelers and entry-level cars, or you look at affordable housing, none of which showed an acceleration. And just before this, I was reading this article in Mint on the rural areas, and how this, we are only looking at food inflation, and what lies behind the food inflation is a lot of crop failure and things like that. If you look at the macro numbers, India's savings rate came to, I don't know, I think 45 or 47-year low, something like that. So those are worrisome things, because those are the drivers ultimately in the long term of the economy. So if there are concerns there, then you don't have economy that's firing on all engines. The market, to an extent, is isolated because listed stocks don't form the bulk of the economy, and also they tend to cater to the more affluent consumers. So you can have a situation where there are concerns on the economy, but the market or even corporate earnings continue to do well. So those, I mean, there can be some disconnect between the two. And one other, I mean, on a longer term, my big concern about the economy is that we are missing out on a large part of our demographic dividend. See, because demographic dividend we think of as having a lot of young people, which we do have. But actually, there are three factors. First is how many young or working age people do you have in the population? The second factor is that how many of them are actually working. And the third factor is the productivity of those who are working. So we are failing on the second count itself. Our job creation is very poor, and it is even worse for the young people. So that is my big concern, because this is the time when you can take the economy and the per capita income to a different plane, because this is available only for a limited period of time. After some time, that proportion of working age population will start to decline, and that time, it's running out. So that's the, if you talk of the economy side,
Yeah,
those would be my concerns.
yeah,
And
and yeah. Sorry. Please go ahead.
yeah, I'm sure I missed out on something or the other which you asked, because you asked so many things.
I
So
I'm
yeah.
at a pro. I'm a pro at asking questions. I mix up all my questions. Sorry about that. But on the economy, what you say about unemployment and all, I think one aspect is it's very difficult to predict macro when you are investing. So that's something. I think Buffett Munger say it all the time. It's very difficult. You focus on the companies, you find the right companies, and they'll deal with the situations, and you'll be fine. I just want to add one line on the unemployment, because not what you said, but typically when I hear people talk of unemployment, they think it is India specific, and I think they miss the larger picture that youth unemployment is not India centric. I think even if you look at data in China, which has had amazing growth over the last few decades, even there urban youth employment is, I think, in the high teens. I need to fact check this, but it's very high. I was shocked when I saw that number. So I think
Yeah,
there
but
is,
Rahul, they are
yeah,
at 5 times our per capita. They can afford to
yeah,
take a breather.
yeah,
We can't. That is a
yeah.
5 time difference.
Fair point. Fair point. They can fund all this. We can't. Okay. A little more about your stock picking process. Why is Devina having all the success she's having, topping those numbers? I get your sheet where you show the comparison of all the PMSs. What is it that you guys do that makes you top the PMS charts time and again?
Okay, Rahul, before that, let me tell you the backstory of our PMS, which is that
Okay.
we had our PMS license for the first time right after the SEBI PMS regulations came out, which was, I think, year 2000 or 2001. But we did not launch a product for 20 years. I mean, it was internally a thing also that we have the brand name, we have the approval. Why are we not launching a product? And my reasoning was very simple, that I don't want to take other people's money till I have something where I have some predictability, some foreseeability, some consistency. So your own money you can manage any which way, but I did not want to manage based on, Devina Mehra's picks. That was not the intent. So we waited till we had a system, and this so I mean, for me, I mean, that's never a thing that everybody is doing it, so let me do it. So as I was saying, I said in one interview a couple of weeks back, that I didn't mind being the very first, not just Indian but Asian firm to go global. In a sense, I did not mind being kind of the last to launch a PMS, because my criteria always is that can I do a good job of this, not what everybody else is saying or doing or whatever. So now our basic engine is based on an artificial intelligence and machine learning system, which I now notice people are just copying the name. So for 3 years, we've been saying human plus machine. I now see new funds and schemes being launched with a man plus machine or man with machine. But I always say that people who can't think of an original 3 word name, you think they are going to do the rigorous work of nearly 2 million lines of code, which is what we have. And we maintain rigor at every step of the way, right from the quality of the data to, how we pick the factors and so on. I mean, that's a whole different discussion. So what the principle behind this, if those of you who read Daniel Kahneman, Thinking Fast and Slow, and his Noise, I mean, he basically says that any proper system will outperform a human being because it eliminates bias and it eliminates noise. So biases I have written about extensively, right from, fund managers' tendency to storify, that I bought this company because of this grand story, that great brand, this amazing management, etc., which in the market doesn't care about your story. So the whole point is that there are biases, there's also noise. You can have, let's say, 15 analysts, all with 20 years of experience, give them exactly the same data, the same company, and they will all have different opinions. That is noise. Your own, one day you come into office having had a fight with your spouse or in the traffic, you will look at things differently. That's also noise. So what a system does is that you codify all your expertise, and then it applies it on a bias-free, noise-free basis on the entire universe of stocks. We have other systems also, but I'm just talking one system, which is the bottom-up system, where, in India, for example, we don't buy micro caps. So we only look at stocks above 1,000 crore market cap and certain liquidity criteria. So roughly about 750 companies. So this system will rank everything from 1 to 750. After that, we apply the human filter, that, the channel checks, the where does this company export to, and so on. So what might happen is that out of the top 75 companies, we might pick 55. But we will not go to rank number 250 or 300 unless one of our other systems recommends it on some other basis, let us say, commodity cycle turn and so on and so forth. So, I mean, yes, since we started, our returns are way above everyone else's. But more importantly, our risk adjusted returns, whether you adjust for volatility or drawdown, are way, way, way above everyone else. And that comes out of the system, because the system also ensures, first of all, that risk is managed. And real life stress tests, we've seen it. So last year, the day Russia Ukraine war broke out, the Nifty and NSE 500 were down 5%, we were down 1.6%. So that's where risk management kicks in. We have a structured product in the globally, which comparable products last year were, I mean, basically wiped out, 50 to 90% down. We were in the plus minus 2% range. So, every step of the way we build in risk management. Again, diversification we've been talking about. And I see now people picking up the word, because there was a family office I went to, and they said, नो देविना जी, वो पीएमएस वाले पहले आते थे, कहते थे कॉन्सेंट्रेटेड पोर्टफोलियो में ही रिटर्न बनता है, only 15-20 stocks. Now the same guys come back and tell me कि 40-50 stocks का portfolio होना चाहिए. तो what has changed in the last 2 years? I said, sir, एक ही चीज बदली है, because we are performing. And people again do not go into the first principles. Diversification will not get you anywhere. What diversification does is it ensures that your returns are commensurate with your skill level. The luck portion comes down and the skill portion comes up. So, I mean, it will work only if you have the skill. I mean, long and short of it is that, because, I mean, in mathematical or statistical terms, it is ensuring that your real result is close to the expected value. So if you think you can pick the right stock 65% of the time, it will ensure that the real result shows that. Rather than when you pick only 15 stocks, you might be right in a chance thing for a year, a higher percentage, but then that doesn't last. So, I mean, we believe in that be consistent, manage the risk tightly, and always think from first principles what you are doing, why you are doing it, rather
Well,
than just copy from somewhere.
well, it's said about bias. Everyone, you ask anyone about a bias, he'll say he's not biased, right? But we all carry some bias or the other. So uh, oops.
Your voice was cracking, Rahul. Now you're sounding better. If you can repeat what you just said, it would be better, I think.
Oh, sorry. Okay, sorry. Yes, they have just biases. Really a lot of the success depends on trying to control all this. How do you do it?
Well, see, every investor has got a different way in which he has come up in life, and he's got a different access to risk, and he's got a different access to knowledge and interpretation of knowledge. He's got a different temperament, he's got different cash flows, etc. So obviously, it's like, two humans are not going to be alike, and that is why we have not really gone into human cloning. Otherwise, humans would have had we would have had race right now, which would have cloned people. I mean, you could have had some common characteristics, but you'd obviously differ in some way or the other.
Yeah,
So the first thing is to sort of understand yourself better, because if you don't understand yourself, you are playing a role both as a human being and as an investor, and the roles are very different. A human can have a very sentimental approach to life and can be very soft hearted at times and can be very hard at times, but investing has to take the sentiment out, and that's not easy, to sort of create the dichotomy there in your way of approaching. So, for example, in my portfolio, if you ask me which is my favorite stock, my answer is none. My favorite stock today and my favorite stock after a few months and my favorite stock after a few years will never be the same. I do not carry any bias that I love one stock at the cost of another. For me, my favorite stock is the one where my thinking proves right. And if my thinking proves right, and it proves right over a longer period of time, then it is even more favorite for the time being, because then it is sort of giving me the ability to buy more and more as we move up. Many people do not average up, they only average on declines, which again doesn't make sense. It's like saying a guy is coming first in class repeatedly, and you say, no, I'm not going to invest in him, I'm going to invest in the 50th guy, because now the first guy I don't like, which doesn't really make sense. The second thing is that, I look at capital from a economic theory perspective, that it has a opportunity cost. There are at any on any single day when I wake up in the morning, there are 8,000 or more scripts before me, and I have limited capital. And my objective that time is to put that capital to the most optimal use that I can find. Now, if that optimal use is in a large cap, mid cap, small cap, buying an existing stock, buying a new stock, I have zero sort of reluctance to do what I think that new track of money can do for me. Then the question is, does it make a difference to the portfolio? And I hear so many people, and I've read so many sort of comments from people saying, no, you cannot make returns if you have a diversified portfolio, blah blah blah. But the point is, if in my own case it has worked, and there is if I, for example, believe that I can do as good as a fund or better than a fund, and if it has worked for me, then so it has worked. Now the question is, which stock in my portfolio ends up being a bigger weightage vis-a-vis something else. This is also decided by the performance of that company, market temperament. You could have a situation where all of a sudden there's a market panic, like that 5% example that Devina was giving, and something that you think is worthy cracks that day because there's liquidity problem, or there's some problem with somebody's margins or something of that sort. And you have many opportunities in that journey. Similarly, one of the advantages of being diversified is that if I get an idea this morning, I don't have a problem in finding out what I have to sell in my portfolio, because in a diversified portfolio, to pick a one sort of egg that's not hatched completely is far easier than in a concentrated portfolio where you build up so many stories in your mind, convincing yourself that these are the best scripts that you will never be able to exit. And therefore, the opportunity cost of the money becomes way more complex. It also completely stresses your mind in terms of arriving at a decision, because you're leaving no margin of error then in your mind, and that's not really good for a investor. You need to be in a free flow state. So I follow those tracks, and of course that's one of the reasons why, as just as an example, and I don't mean it as an investment advice, I had no reluctance to buy PSU banks and shun the top private sector banks if I had to. If I felt that the trade was good for me and it was a good investment for me, so be it. And if I was wrong, I would have carried the lessons of it. So if the moment you create preset biases in your mind, your investment process is an extremely difficult one. In fact, I do not like people who post too many theoretical messages, too many of quotes from books and this and that, blah blah blah. It just doesn't work. You're just putting these quotes without reference to examples. You cannot take even a Buffett or a Charlie Munger and say that this is what they said. I mean, their behavior itself is so different over different periods of time. They have done everything, to the contrary to what is said. So be an open minded person, and if you're able to apply certain rules that work for you and sort of give you the ability to mitigate risk, because everybody's seen downfalls in the market. Now we've been like bruised by those downfalls many times. So the only thing I can do is to go back and see that whenever these downfalls happen, what went wrong, and to whatever extent I can mitigate that risk, so be it. Like, for example, keep some separate money with you to meet your livelihood and other requirements. And I won't even call it livelihood, I will say to even meet some of your luxuries. And if that is not going to be an obstacle in your mind, then the market falls will not trouble you to the extent that they will trouble you if that money is required for a marriage or a home or a buying a inevitable asset that you cannot defer.
Very interesting, very thought-provoking, and it's very actionable. It's tough to action it, but it can be done, and it sounds so logical. Devina, small caps. What can you talk specifics of what's starting to bother you, and whether you think that we are closer to the end than to the beginning when it comes to small caps?
I'm not even saying that that is necessarily the case, Rahul. It is just that, there's been too much euphoria and too much money pouring in, and a lot of people who do not have either who have not lived through, obviously, a whole lot of people have not lived through the previous crashes, but who do not even have a sense of history as to what can happen. So
Mm-hmm.
that part is the worrisome part. And also, even if the index itself doesn't crash, the index goes down 5-7%, individual stocks often in that area can go down 15-20%. And there's like a lot of froth, as Safir also mentioned, that a lot of people talking about lot of stocks which are fairly new. So that is the part. I mean, I remembered later that one of the your sub questions in the last question was the sectoral stuff, because you had everything from economy to the sectors in that question. So, in terms of sectors, just again,
This space was downloaded via spacesdown.com. Visit to download your spaces today.
I mean, obviously we are just coming to the quarter end, so what our systems show this quarter, I still have a couple of days to go before I get those results. But as things stand, the sector we have been most overweight on for quite a long time now. In fact, almost exactly 2 years. We started in October 21, was capital goods and is capital goods and industrial machinery. So that's a sector that we've been most overweight on. I mean, it's not at the peak weight that we went to. We've booked some profits. We've changed some stocks because stocks there went up 2 times, 4 times. So people have started talking of industrials only in the last few months, whereas we have liked it a long time. And in fact, the question I ask every quarter is that is the run over? But till now, our systems have not shown that the run is over. And also there's a background to that the sector was an absolute underperformer, absolute dog sector for a long time. So from 2009 to 2021, so good 12 years, it was an absolute dog sector that gave a 2% compounding over that period. So the companies also, they were shake out. There were companies that were left became lean and mean with the minimal cost. So when the turnaround in demand came, they were all set to take advantage. So that sector still remains number one for us in terms of overweight. Again, we are always very diversified sectorally. So, we will never have like 40% in a sector or something like that. This calendar year, where we have added has been auto components, pharma, couple of construction companies, IT, especially mid-cap IT, is also beginning to look better. We're not heavily overweight, but we'll be slightly overweight there. Where we have started to cut has been banks. I mean, somebody on Twitter told me कि ये तो आपका तकिया कलाम है कि I'm a nervous investor in banks, but I am. So I am so I'm a very investor in all lenders because lending is a risky business. It's a highly leveraged business. It's a business where, as an outsider, you don't know where the skeletons are hiding, where the negative surprises will come from. And so that said, I mean, we never had significant exposure to NBFCs. Banks we have cut back, and as Safir was mentioning, ours also has been skewing more towards the PSU banks. So that's where some of that money for other overweight bets has come from. And I think that in sectorally, that would be broadly what we have liked of late. I meant pharmaceuticals. So pharmaceuticals is
Yeah,
another one where we have added. So that would
that's
be
quite a
about it.
broad. Yeah, that's quite a
Yeah,
broad
we have
range of
always,
sectors.
I mean, we always have 50, 60 stocks in our portfolio. And many times they're not sector bets even, and I was looking at our top performers each year. They have varied, and many of those stocks we don't hold anymore. Deepak Nitrite might have been high up in 1 year, or Tata Elxsi, but we may not be holding them now. So, and also like last year, among our top bets were, top performers were ITC and Raymonds, which were not sector bets. So again, as Safir was saying, that don't have preconceived notions. And that is what the system also forces you to do. like in 2020, when FMCG was the flavor of the season, I had done a whole half-an-hour program on CNBC saying that there's nothing like a stock or a sector that always gives you returns. Even if they are in a stable business, doesn't mean that the stock will give you return. But at that time, when everybody was rah-rah on FMCG, nobody was even talking of ITC as an FMCG stock because it was not performing at that point. But for our systems, in the next year, it was the first FMCG stock that our systems liked, and we bought it, and it was a grand performer for us. So that's what the system forces you to do, to at least get out of your biases. And if the system likes it, then you have to have a good reason why you are saying no to it.
Wow,
There is
very
a
interesting.
in
Very interesting.
systems they say, it's a broken leg analogy, that they say that, let's say you want to estimate that will such a person come for this concert, and you have whatever x number of variables, so that will do better than a person estimating it. Only exception is when that person knows for sure that this person has a broken leg and hence can't go for the concert. So
Hmm.
unless, so like, for example, last year, one of the chemical companies our systems like, but then when we went into the fundamentals, we said, they have too large of an export book to Europe, so maybe, next quarter numbers won't be that good. So we did not buy, and that turned out to be correct. But then you can't just generally say no for no reason.
Yeah. So, like I said, a broad array of sectors as the result, of a process where you invested. Safir, I know Davina, I don't think we'll talk stocks. Safir, but what about you? Could you share, as you stand today, uh, how is your portfolio leaning in terms of sectors and stocks, if you're comfortable?
See, as my portfolio stands today, may be very different from where my portfolio stands after a month. And if many of the people on this call are not, literally aware of what changes will come, then they could be misled. So that much of a sort of a caveat they have to carry, because if somebody listens to something,
Yes.
it's very different when you have a secular idea and you say you're buying a company. And we've been fortunate that some of the companies that I have spoken about or have expressed my liking for have done exceptionally well in this market. But then if you ask me that did they expect those stocks to go up 5 times in 1 year and 4 times in 1 year, and will they go up 4 times more, or will they even double from here, I'll say I don't know, because that will depend upon the results that they show. I mean, just to give you an example of the level of uncertainty, so many funds in India own Naveen Sorokhem, and today the resignation of a key person brought down the stock by some 16-17%, close to 52-week low. So the entire gains of Naveen Sorokhem for the entire year, or maybe 2 years or 3 years, came to zero. Or maybe not 3 years exactly, but 2 years came to zero because of an unexpected development that happened in that company. So there will always be these unexpected developments that will spring a surprise. Now, I have, for example, a overweight on banking for the last few years, and if there is something that is going wrong in terms of, say, one of the PSUs comes up and says that, again, we have to do an NPA recognition, which is very high because some account has gone bad, it will obviously have a trickle effect on other things. And then will I have the capability to distinguish between, a good bank and a bank? No, I will not, because I will not know next quarter who's going to spring a surprise. But right now, I'm more, encouraged by some of the statements that seem to be coming from RBI, some of the statements that are coming in from NCLAT, some of the recoveries that are happening in respect of asset reconstruction companies and other things, to believe that yes, they are coming back from a very bad past, and to that extent, so far, it appears that the thing is good for them. So that's just one example. As far as sector is concerned, like I told you, I don't wake up every morning to a liking of a sector. I wake up to, and I don't mean literally every morning, but I wake up to the opportunity before me. If I read in the newspaper or some article or some international magazine I've just come back from a foreign trip. Now I'll give you a very interesting example. Many people are looking at the market, and for example may believe that the market is sort of overdone, because you will say 2024 earnings and 2025 earnings are being discounted by X times, depending obviously on which company or sector you're talking about. And then people will say, but you have a PLI, and that also to some extent may be discounted, and you may have other incentives. Now, when I was in Europe, the European companies were actually taking a different stand. Their stand was that we will invest in India once we find recovery in Europe. Because one of the reasons of investing in India is to make for the rest of the world also. Like, they will not just come and invest to make in India. Many companies, when they look at China plus one, China was a base for them to export to the rest of the world. Now, if the rest of the world stays in recession, many parts of the world are in recession and uncertainty, then they don't have the reason to invest today. And if they don't invest today, then the ancillary effect of that on many companies that are, sort of going to team up with these companies, provide parts, etc., becomes impacted. On the other hand, if they find that there's a resolution because certain parts of the world, recover vis-a-vis something else, then that level of investment is a long-term money coming in the short term. I mean, somebody will set up a plant in India for the next 10 years, but that money will come in very fast. And that very fast money will benefit a lot of companies that, it's like the axe and the shovel example. So they will benefit a lot of other companies. So therefore, investing is a journey, and there is no favorite except to keep investing and to remain diversified, and where you find your bets to sort of keep increasing, and where you find doubts. That's the other thing. When I have a doubt on the company, I don't like the doubt to linger on. I wait for a day, 2 days, 3 days, and my intuitive feeling is 3 days also I'm worrying about it. Then I feel 8,000 companies में एक चली जाएगी तो क्या हो गया? I mean, what's the big deal as long as your portfolio does well? So keep an open mind and keep looking for opportunities. There are going to be a lot of opportunities, but there'll also be a lot of setbacks.
Yeah, yeah, that's a valid point. Okay, so we're going to take some questions, but house rules. Please keep the questions very, very brief. Yeah, just a few seconds, please, so we can take as many questions as possible. Uh, Prince, you're going to help me with this? I am not sure how we're going to do this. Prince, you there?
Hi, Rahul. So, Rahul, I'm as a speaker not able to add anyone, but I can help with the questions in the comments. Meanwhile, I have a small question to Devina ma'am and Safir sir. So, basically, these days, like there is, more focus of people, especially the retail, on that order book investing. So, any thoughts around that?
Superb question. Superb.
So this means what? That you're investing based on the order book of the companies, or
Like,
does it mean something else?
in the morning, there'll be breaking news. Some company's got 100 crore rupee order to build some railway track, right? And the next thing you'll have is the stock will rally like crazy for the next few days. And it's been happening across sectors. I think, Prince, that's what you're referring to, right?
Okay, buyer beware is what I would say. So there are,
And
many.
Safir will say, true to form, cabby tempter, since he's a lawyer.
No, I will say as a lawyer, other things being equal.
So I mean, you should look at the news, but don't get swayed by just one piece of news. And also, in many of these, you don't even know how that will actually pan out, whether that project actually goes through, what happens. Like, I mean, just to give you an example, the Sea Link in Bombay, I mean, that became a millstone around the neck of the company which had got it, because there were overruns which were not then getting passed. So I mean, that actually became the reason for a spiral down for the company. So I mean, just getting an order is not the be all and end all, and definitely not the sort of thing where you should be putting any big bets. So as I again repeat, investing is a loser's game. So be sure that you are not uh, taking a risk where there is a risk of a big drawdown. And as Safir said, there are plenty of fish in the pond, so you don't have to do anything. And also think about this, that you are an outsider. By the time the news is coming to you, obviously there are a whole lot of people who already knew about it, and so therefore, I mean, be careful about this whole thing. And large orders from a single entity are carry their own risks. It is not the same thing as a revenue which comes from a diversified consumer base.
I just
Uh,
wanted to add one point to this, and in just as you're talking in the context of order books, it is very sad, and it will have a very bad ending for sure, because people are not investing in IPOs by reading what the companies are doing or what their projections are. They're investing in IPOs based upon gray market premiums. I mean, I've never in my life for the last so many years seen so much of activity around this GMP or whatever it is called every day. Now even prominent newspapers, when they cover an IPO, they will say that this is an offer for so and so share, and these are anchor investors, and promoter holding will be so and so. They don't talk much about the business. You will not, if you can Google at least about 10 of the IPOs that were listed, hardly anybody talking about the business. The next column will say great market premium is at 30%, 20%, so and so, so and so, and people are looking at that number and oversubscribing. Now, I'll give an example. I was tracking just for academic interest. I don't have a investment in it. An IPO that came recently, it was oversubscribed 100 times, and the gray market premium was supposed to be some 40%. Eventually, when the company was listed, I mean listed as of today's price, the premium is only about 6% now to the offer price. Now, are you telling me that everybody in the world was making a run just to get that 6 rupees of pie, which effectively has sort of fizzled out completely? It just shows. If you look at so many of the IPOs, while somebody will look at the offer price and say they're up, but somebody will look at the high price and say, but they're down so much. And literally nobody's understanding this. In fact, some of the IPOs are now below offer price. This is a clear frenzy which is making absolutely no sense at all. I don't even see these companies being spoken about, beyond a week of their listing. In fact, in some cases, I was observing the commentary of one of the companies that came for IPO. The promoter is saying, because you guys oversubscribe so much, in the next 3 years, we will reward you and not reward the promoters. Now, what kind of a statement is that? You will reward them for subscription, including of non-allottees. It's so silly.
well, well, since I'm my
Yeah,
father.
Samir, just to add, since you were talking about IPOs, the only part I disagree with is that this has not happened before. The gray market premium may not have been there in the pink papers, but I mean, the IPO frenzies come with unfailing regularity and with, again, as
No,
John
no,
Kenneth Galbraith.
I'm not talking about that. What I'm saying is, I remember the times when IPO forms were also sold at a premium. I'm not on that.
Yeah, yeah. No,
What
no,
I'm
no,
saying
no.
is,
I get you. All I'm saying is
कोई
that this
company के बारे में
happens
लिखता ही
with
नहीं है.
unfailing regularity. People forget Reliance Power or to chodo. I mean, DLF, when it listed, I mean, it was again a hyped IPO. It even, I think, doubled on listing and then never saw that price again for decades. So, I mean, people just forget. I mean, I was looking at something in 1881 in on the Paris board's IPO frenzy, so that the equivalent of their samosa and batata vada walas were handing out short prospectuses. So, and I was looking at my video of 2 years ago, November 2021, when all this, this phase of new age tech companies came in. And exactly the point that I had pointed out then, that if you prove a business model, more people will come in and so on. I mean, that's what you're seeing playing out in that lot of stocks, the Nikas of the world. So, but I mean, at some point, uh, people just start to think that this is a lottery game, that you
That's right.
that you are just playing a process rather than buying a company. That you will just flip out and you will
No,
find some greater fool till that bubble bursts. I mean, that is the
Mhm.
that I mean, I would recommend to all of you to read this book called A Short History of Financial Euphoria. It's a very short book. You can read it in a single sitting, but what a book. And it lays out how bubbles form and why it's a characteristic of financial markets to forget history, and therefore bubbles form again and again,
see,
and then they
to
burst.
add to what you're saying, any person who would have read generally some basic books also would know that in order to succeed in a wager or a bet, the chances of success for you will become much more difficult when if you do too frequent bets. Now, what is happening is that if you are basically betting only on grey market premium and the speculation and options and all this, even the exchanges are now feeling the need to increase the spread for you. In fact, I find this move to increase to allow trading at 6 o'clock and 7 o'clock and options and all without increasing the depth of the derivative market completely meaningless. So what's basically happening is you keep increasing IPOs, you keep increasing the hours of trading. Now more and more people keep betting, and eventually, it's the bet size keep going up, and then they get hit. So, which is why the statistics is suggesting that 90% odd plus of people who are doing this sort of speculative trading do not end up making money. But they're getting more and more lured because you're just showing them carrots and carrots and carrots and carrots.
In fact, the interesting thing is not only that 90% of them don't make money, but even the 10% that make money make an average of something like 5,000 rupees a month. So there is, even for that 10%, there is no great, pot of gold. But
Like
I mean, people
like
hate
someone
to
said,
look at statistics.
like someone said on X, right, that the regulator and the exchanges are not happy that 90% only 90% people are losing money. They're going to increase the trading hours to take it up all the way to 100. But anyways, okay, let's take some questions. Cyrus, you go first since your hands up. Please keep it very, very brief. Okay,
Yeah, this one
Cyrus,
is
over to
for
you.
Devina. I am a very avid investor in small caps. And my question to you is, assuming you have done all your homework, due diligence, everything, and you zero in on a small cap, and suddenly after a few quarters, you see revenue and profits falling. So after how many quarters of falling revenues and profits makes you feel that this is not a temporary phenomenon and now is the time to get out while you can?
Okay, great question, Cyrus. Over to
So
Devina.
there is no formula to this, which is why I say diversify, because even if you're doing it yourself, don't have, I mean, like a small case usually has between 25 and 30 stocks, which is, I think, the bare minimum you need to diversify, because out of that, now, one of the biggest mental flips you can do is that when you make an investment, tell yourself that I may be making a mistake upfront, because it is a given that a certain number of your investment decisions are going to go wrong. And this is one of the things which human beings go wrong with, because they hate to admit mistake, they hate to take losses. There is a loss aversion bias that is built into us through evolution. So that's why biases are so hard to get rid of, because they serve an evolutionary purpose. So coming back to your question, I mean, there is no formula to it. Maybe you should, get out at the first instance. Who knows? I mean, depends on why that revenue has fallen and what industry it is in, and so on. And always is, be quick to take a loss and get out. Holding on in hope is not a good thing. So, I mean, like, for example, if we say for our PMS or small case that on the buy side, it is a human plus machine model. On the risk management side, it is a machine only model. So if, for example, a stop loss is hit, you get out. We don't allow human beings to override, because human beings will override. They will say this stock is different, this time it is different, I'm convinced it will come back. So, and in a small cap, you have to be even more risk averse, because often, as I said, there are no exits in the first place. So and in small case, your hit rate, small caps, your hit rate is going to be lower. There'll be more number of times you will go wrong.
Okay, let's move to the next question. Ravi, over to you.
Thank you so much, Rahul, and fantastic space, Devina and Safir. I work in the space of green growth, so my question really is from a future perspective, which is really looking at investments in the green growth space. And, what are your predictions and maybe calculations when it really comes to the Indian market really standing on to issues of like green energy, EV, solar, biofuel? And I know that maybe it's too early on, but I think it's great to come in early on in terms of investments. Just to add to that, we're organizing a Green Growth India Investment Summit in New York in November. So really, it's ready to look at from the future green market. So going into that space.
Mhm. First Devina and then maybe Safir.
Okay. So you may not like my answer, Ravi. Now, I mean, this is my framework, and I tweeted this also a few days ago. That just because a new business or a new technology is going to make a lot of changes in the world. It's going to revolutionize the world in a sense. It doesn't necessarily mean that it will be a great investment. So first of all, there are many times that technologies show promise, and they're talked about, hyped, and you go back over the years, you'll find many of those, and they may not even live up to their promise. But I'm saying even the technologies that live up to their promise, and two big examples in the last century, automobiles and air travel, fundamentally changed the world, fundamentally changed how humans live. But both of them have been a graveyard of companies. If you go back over the history of airlines, if you go back over the history of automakers, it's been a graveyard. And even the so-called companies that made it, what were the big three in automakers in the US, General Motors, Ford, and Chrysler, even then that they also went through crisis. So, especially at the beginning, you don't know who's going to be the winner. And often it is not the first guy who not just makes it, but even makes it big. I mean, before Facebook, Orkut was the in this thing. And now the whole cycle of companies is getting shorter. At one point, Nokia and BlackBerry were the thing in mobiles. Now it is something else. So, as I said, just because a technology genuinely changes the world doesn't necessarily even mean that you will find the right investment in that. You don't know who the winners will be. Safir, anything you'd like to add?
No, there's a completely different approach when you look at a sector per se, which is, for example, you say green energy, and I'll say yes, green energy will do well. Now you basically say that which part of green energy will do well amongst the listed spheres. Then my question will be, how do you assess that the unlisted sphere will not do well? How do you assess that new technologies will not come, which will disrupt? I mean, I'll give a case study. Look what happened to Mozambique when it got into photovoltaic cells. The entire company came crumbling down because the technology failed, and same thing had happened with CD technology and the cost, and so many examples. Some of them Devina has just shared. So the difficulty is that you cannot access, and then our market gets euphoric. Like, for example, even if you find that there are good companies, they may be good, and maybe Ravi, you've got better insights because you handle this. The question is still going to be that the market has not left any valuation comfort, because everything is, if just because it's a new sector, it is valued at 50 times, 60 times, 70 times. And then you look at the stock behavior, it is, if most of the moves would have come in the last 3 months because of more of social media impact. Somebody just coming and spinning a complex model around a company saying that this is now into XYZ field and look at the potential that it will have. Now reverse it, you will find that the chairperson of Maruti is not very sure about, when it comes to e-vehicles. He's saying that I'm going to experiment more with gas vehicles, and they're working on that line. Toyota is not making forward statements in respect of what they're doing. I was in Germany and I met almost the all top automobile companies. They're saying we don't know what is happening with lithium or hydrogen or something. We are experimenting to see. Their primary objective is not just the green technology, is also to make cars lighter, which therefore is going to have another trade-off. How do you make the car lighter because of the lithium batteries and all, make it more heavy? Mercedes new e-vehicle has a problem that the battery is right at the base of the car, and in India the speed breakers and the road bumps end up being way higher than in other countries, so they don't know what impacts it will have. So the question is very difficult to decide. And the even companies like Hindustan Petroleum, Bharat Petroleum, Indian Oil, all these companies are not coming out with documented policies. that really say even the government is experimenting. Like for example, we are doing a lot on the ethanol front, but the rest of the world doesn't follow ethanol now. Whether it is good for India because from an import perspective it does well, but is it good for the environment? Well, it's not something that is very clear in terms of that. So will it end up in continuity, in perpetuity? No, but in the short run, of course, it is giving a lot of boost, and I'm also a beneficiary because I own some of the sugar companies. Do you think I can own these sugar companies for the next 10 years? I don't think so personally. So it's like you can take a bet on a sector, but it's very difficult to take a bet. Now, if you are very lucky to get in very early, and you have the ability to understand the sector, then of course you may strike a better return. But it is not going to be easy for most people to sort of decipher this.
Okay, great. Prince, you have a question.
So, Devina ma'am and Safir sir, so we have a election year ahead. So, any correlation, from your past experience between the markets and election year, and especially in lines with the infrastructure sector?
Hard to say, Prince. I mean, hard to say. I mean, obviously, generally, the government tends to spend a little more, when the elections are coming up. And even for that matter, the market reaction to elections, you don't know, because I was just thinking about 2004 elections, and I mean, makes you feel old that it will be 20 years. But on the day of the election, when very unexpectedly NDA did not win and the Congress-led UPA came, the market fell 11%, and I think it was 15% intraday and 11% end of the day. But then in a few days' time, it made it all up, and I think for that year it was up 23-24%. So those kind of things are very hard to say, and I don't think you can really invest based on that. That would be my thinking, and I think that to a large extent the engine of the economy anyway goes on, regardless of what's happening on the political front. Safir?
Safir, you want to add anything on that?
No, I agree this. In fact, typically, if I look at from the perspective of a new government coming in, or new government means including the continuity of the existing government, first point is that what is so radically different, because they have anyways taken long-term plans. Most of the focus of this government has been, large ticket changes, which have already been going. It is as much as the budget has become inconsequential. There was a time the budget had so much importance, but every month on month there are, there's some announcement happen on road, on infrastructure, on policies, on trade bilaterals, etc. So it is not that the direction of that is going to substantially change. And I do not personally believe that even other governments, even if in some parts of India there are, for example, non-BJP related government, they are going to radically change their policy, because some of them are now aligned to GST and other national policies, and FDI, and state related investments, and so many other things. So I don't think there's going to be a substantial change in anything. In fact, I believe the fact that if a substantial part of the infrastructure gets done, and I mean basic infrastructure, which means like roads and other things, get settled, then the government might be left in a few years down the line, maybe 2 or 3 years down the line, with certain surpluses, the way the tax collections are, which may enable them to finally look at cutting taxes, particularly on the high tax payers, which is a sector which is a segment which, according to me, has been ignored for a lot of time. You cannot endlessly keep going and taxing the highest taxpayer again and again and again. And if that tax cut comes, then they will have more incentive to invest. And I don't mean stock market investment in capex and business expansion, etc. It's already happened for the corporate, which is very favorable. But I do believe that, at some point of time, there will be incentives for the highest end of taxpayers as well.
Okay, wonderful. Last question. Babulal, you may unmute yourself.
Good evening to all. I am Devina ma'am. So my question is about the turnaround stories. For example, Tega took over their forward manufacturing by McNeil strategy, or for that matter, Suzlon deciding to get out of the debt. Such turnaround stories, or entering in the beginning like Trans India Limited, where the company was just unknown to anybody, and those who entered it, right, including me. So, how do you take these turnaround stories?
Very cautiously and very carefully.
Okay.
Only if you know for sure that something is happening. I mean, it's right that even if you look at a cyclical industry, let's say a cement or a steel, when an upturn comes, often the worst company in the industry gets the biggest boost because it's the biggest beneficiary. Because if let us say there are two companies and one has a margin of 10% and one has a margin of 5% and hardly any net margin. If the margins go up 2-3% point, that the worst company's net margin goes up the most. They can repay the debt, and if the price goes up, maybe they can raise some equity money. So generally, that's the good outcome. But many times these stories are floated, and you may not know whether that is the whole truth. So only if you can verify the details and you do the numbers, always do the number that how much of an impact will this thing have if they repay the debt, or if this happens, or they have some thing with the something changes either in the business or in the financial structure. But whatever you do, you should not take outsized bets on things like this.
No, certainly not,
Because
ma'am.
this is the sort of thing where you might have a multi-bagger, you might have something going to zero also.
Yes.
So, and especially as an outsider, as a lay investor, do your homework carefully, and even then don't take a very large bet.
Yeah, I fully agree with you. First of all, I never invest in the cyclicals. I am from manufacturing field, so I study company well. Only if I like their manufacturing model, then only I invest. I do not invest in every turnaround story, and not certainly hearsay turnaround story. Only whatever is seen in practice.
Okay, great.
Yeah.
Thank you, Bob. Thank you. Okay, I think we need to close this. We're already over time a little. Devina, any final comments for our attendees? And then, Safir, you can follow up after that, please.
Yeah, so once again, thank you all for being there. And I would say that respect your money. So, this is hard-earned money that you're putting in the markets. So don't do things arbitrarily. Don't do things based on what some Telegram group is telling you, or what even what somebody on TV is telling you. So have a systematic process, even if it is a simple process. So even if let's say you say that I want to buy companies with this kind of growth, this kind of return on equity, this kind of PE, whatever your 5 criteria are, then you filter companies according to that and buy that. Because what I find is that you might say all these things, but when you actually look at the portfolio, you have bought some stuff which the last party somebody recommended, and so on. And also, I mean, the most critical part, which we didn't get a chance to talk about this time, is that look at your asset allocation. So always, I mean, where you want to be in your asset allocation is the second step. But as I say, in Google Maps, you first have to put your current location or where you want to start from. So look at your current allocation of how much is in fixed income, how much is in equity, how much is in real estate, how much is in gold, and so on. How much is outside India. Again, one thing which we didn't talk about, that you must have globally diversified portfolio. Only if you know the starting point, then you can go to where you want to be and how you get there. Because most of your return is determined by that. Within equities in India, a lot of your returns will be determined by the sector you are in. So always be cognizant of where you are on all these dimensions, rather than arbitrarily just adding stocks from here and there. So respect your hard-earned money and manage it systematically, properly, not arbitrarily. Yes, Safir.
I think I will agree with that, and that is their words of wisdom. My essential point for you, for anybody, would be that when you come to the market to buy a particular script, you must ask yourself that why are you buying the script in the first place? Because if you are buying the script just because, and I'm talking from personal experience. I mean, there are people who come to me, they have so much of a feeling of being left out with the small caps and mid caps, that now they want to just buy whatever they can lay their hands on. And some of them get so desperate in that joining the race halfway through the racing track, that they believe that by buying more quantities they would be able to sort of compensate for their inability to do a process that is like an SIP or a, over a large number of years. And I find it very, very weird that in the investment world, the more exotic you make a product, the more complex you make a company, the more subsidiaries that it has, the more related party transactions, the more block deals, people like it even more. I also don't understand this notion that why you have to buy companies only when they break DMAs and go into highs and other things, when you know over a period of time the law of the land is that there's averages, and under penetrated sectors catch up, and over hype sectors fall. But everybody wants to get up in the overhyped sector as if it's not going to end and it will cross the skies also. So you have to be diversified to that extent, because it is very difficult in the market to know how long the euphoria will lie. And most importantly, when the market corrects, why do people get into this massive mode of literally like panic? Like if in the last few days, if the market corrected 4 or 5%, I've even seen TV channels saying the market is crashing now nobody has interest, etc., etc. What is this crash that we're talking about? Because market is defined as an opportunity. Whether that opportunity is in a large cap, small cap, mid cap, something that has gone up 10%, 20, 30 is a completely different thing. It is not as if everything is going to fall in everything. I mean, things can fall, but not everything is going to fall at the same level or rise at the same level. And even if you buy something that falls, as long as you have a focus on what it is doing and you have the ability to keep sort of lingering on and adding to it, or being patient and sometimes doing nothing. I mean, you can be sitting in the market and doing nothing and being adequately rewarded. But that feeling within that I have to be super active and I have to be the superman of the market is going to be quite destructive, because it will just drive your thinking crazy. And I also don't understand this, why people try to emulate other investors. They may have better skills, you may have better skills, you may come out with better choices if you go through a process of learning. If I was to, for example, call all my friends who are in the investment and ask them what they are buying, I would be the most confused person, because I'll be in a complete tug of war in different directions. And then it becomes very difficult to invest. And coattailing doesn't succeed typically. I mean, you can see even from the examples of late Mr. Jhunjhunwala, he made a lot of money on some stocks, maybe 5, 6, 7, 8 companies, but he lost a lot of money on 60, 70, 80 other companies. You could have been in the 60, 70, 80 other companies pool. So don't believe that you know anything. And some of the highest, and I also don't understand this notion that quality is not a function of, in the stock market, quality is not a function of the quality of a company. Quality is the function of the quality of returns. They are completely unrelated. You could buy a company that is not the highest level company, the market leader, and you could have substantial returns. And you could buy the leader and sit with no returns. And then you will keep giving lectures to the others saying, but these are high quality companies. But your money is not growing, even inflation is killing it. So have that sort of mindset, to sort of absorb that and to adapt to that. You have to adapt to the market.
Wonderful. Thank you very
Okay,
much for this.
just
Yeah,
one thing I want to add,
yeah.
which is really taking off from what Safir said, which is that the worst mistakes you will make are because of FOMO, this fear of missing out. So, I mean, I see, which is exactly what Safir also spoke about, that, don't try to jump onto a bus you think has already left. I mean, one of my favorite quotes is, it was in Richard Branson's book. I don't know whether it's his original or not. The opportunities are like buses. There's always another one coming along. So you will get the next bus. Don't try to jump onto something which has left the station.
Great. Thank you everyone for attending. Thank you, Devina. Thank you, Safir. I think we should definitely do another spaces where the key focus areas include asset allocation and international investing. The ones that we missed today because we ran out of time. It's been wonderful. My parting message to all the attendees: please, your money, your responsibility. Think hard, take care of your biases, and please, if you're following influencers who have no track record, please rethink your strategy, right? Your money, your responsibility. Chalo. With that, have a safe year ahead, and happy investing.